as long as something is not defined, we call it intuition. Over a period of time, more and more things which earlier were in the domain of intuition get codified, and then it becomes a system-driven process. A mentor kind of relationship, or another father figure. So biological parents are of course there, but in the professional world, someone who would oversee the career paths of various people. So he was that kind of a person, which is very, very difficult to replicate or to find outside. Any investment manager has three bosses. One is the end client. The client in an open-end structure can fire you anytime. Here is my redemption, give me my money back. The second boss is the person who got the client to you. This could be a mutual fund distributor or it. And the third boss is the organization CEO, the head who leads the organization. Globally, this sentence is famous in the investing community: price is what you pay, value is what you get. In the Indian context, someone has modified it: price is what you pay, value is what the promoter will let you get. If we are running a Udupi restaurant and we serve the best dosas in the city, we should not worry about someone else serving great sushi. That's good for someone who's interested in Japanese food, but then we should not try to do everything and be everything for all people. Watching the big TV screen is a big part of my existence, whether that is a documentary or something fictional. But
Hi, I'm Satya Sundanam from Zerodha Varsity. This is the second episode in the Know Your Fund Manager series. Today, I have with me Rajeev Thakkar, the CIO, Chief Investment Officer of PPFAS Mutual Fund. I asked him what should investors investing in his fund should expect. He says that the fund may not give the highest returns, but it could give better downward protection when the markets correct. He says that he's scared of people's expectations of highest returns. I visited his house at Andheri in Mumbai to chat with him about his investment principles and the style of investing and what should investors expect. Enjoy this beautiful, candid conversation with Rajeev Thakkar, the CIO of PPFAS Mutual Fund. Hello Rajeev, thank you so much. I appreciate you taking time for this.
thank you for the opportunity, Satya.
How do you maintain that composure and calmness all the time?
One thing to, especially in the public appearances, if one is on stage or one is doing media interviews, I think it helps to tune out everything else. So right now I'm talking as if only two of us are here and we are conversing. If one ignores the camera and the large audience, that helps in terms of...
I've talked to others as well, someone in the financial industry. I asked them to describe you, and two things that they always say is knowledgeable and calmness. So that's why this question.
Sure. So I think some of it could be inherent nature or things like that. Some bit of meditation practice helps in this regard.
How do you identify yourself as an investor, Rajeev? I tell you why I'm asking this question. As per late Parag Parikh's book, Stocks to Riches, there are three kinds of investor. One is the one that takes intellectually difficult path. They try to understand the science of investing, try to look what are the future trends are, and understand the business environment. They invest, find the opportunities, invest, stay for long term. Patience is the virtue. That's the intellectually difficult part. The second is the physically difficult part, where these investors try to keep up with everything that's going in the economy, globally, etc. Try to time the market. It is difficult because they have to keep up with everything, keep tab on everything and time the market and try to outbeat the market. They might miss spending time with family and friends. This is the second one. I'm sure you definitely do not belong to this category. The third one is the emotionally difficult part, where they say, when news reports say, stock market is doing really good, it's up, that's when you actually take time, be cautious. While on the other side, when people say the markets are crashing, that's when they try to get in. So what kind of an investor that you relate to yourself?
Sure. So to summarize what you said, in the finance literature, people use three kinds of edges. One is called the information edge, the second is called the analytical edge, and the third is called the behavioral edge. So information edge, you refer to people try and absorb all information and get information before anybody else. So they will do market surveys, or they will do social media sentiment analysis and things like that. So the problem with information edge increasingly these days is that a lot of information edge has been outlawed. So things that were earlier legal are no longer legal. So the companies have to record each investor interaction. They have to, there is a closure window where employees cannot transact. Regulators ensure that the same information is available to all investors, small and large, at the same time, rather than a staggered manner. So that is becoming increasingly difficult. To counter that, people went into this thing of taking satellite images of parking lots to estimate sales and things like that. But that is not who I am, which you correctly pointed out. That is not what we are trying to do. The second is the analytical edge, where you claim to know better than others and you are able to analyze the same data in a much better manner. Again, that is not who we are. The simplest path is the behavioral edge part, where you keep your own actions under control. You don't get swayed by the ups and downs of the market. And if something foolish is happening in the marketplace, rather than participate in that foolishness, how can we try and take advantage of that foolishness? So that is what we try to do.
And I think this can be explained well by giving the example of what happened in March 2020 when the markets were, falling. I think PPFAS has taken a stance to invest, when everybody is selling. Because times then look very cautious and, dismal. That's when you took the decision.
Yes, so some people would argue that it's because it worked out for us, we are able to say this. What if there was a Great Depression after the pandemic? And a lot of people were predicting a Great Depression. And history does not deal in counterfactuals. So in a cricket match, after the match, people will say we should have chosen to bat, or we should have chosen to bowl, or this person should have been there instead of this person being selected. So without giving too much importance to how things panned out after 2020, what if something else came up in 2 years? What would guide our investment decision? So before an event happens, you should be clear in your mind, if this happens, this will be the action that we will take. So for us, the guiding principles are business strength, business quality, management quality, and valuation. So if these things are aligned, then we will go out and buy. Then other factors, and this time it was a health issue, it was a pandemic. The earlier version was the global financial crisis, where banks were going bust. It could be a war kind of situation somewhere. Factors could be varied, but if your principle is that we will buy when valuations are very attractive for very, very high quality businesses, then we have to go out and buy. Things may normalize in 6 months. Sometimes it may take 5 years for things to normalize. That is not in our control. So once you have pre-decided, it's like the airline announcements that come up. If we say evacuate, then you pull this and you pull this lever. Then you don't have to apply your mind. That's what we do.
I don't know where I've read this, but when you actually put systems in place, that's when you actually can overcome the behavioral biases that we inherently have.
Absolutely.
Yeah. Talking about this, when you're building this system, the process within the organization, you would have leaned towards one style of investing. Ask anybody outside, they consider you as a value investor. But you yourself and the rest of the team also, when they're talking, mentioned that, referring to what Warren Buffett and Charlie Munger says, that value cannot be decoupled with growth. Why don't you talk about that?
Sure. So let's take two example of two companies. One is a mature company where you expect the sales to remain constant, profits to remain constant. Right now, if that company has zero growth but is giving you 15% dividends each year, it will give you a 15% return over your holding period, assuming price does not go down. This is a zero growth company giving you 15% returns. There could be another company where currently they have to reinvest capital to get the sales growth, and they don't expect to pay out any money to shareholders in the next few years, but they are able to grow sales and profit at 15% and it's reasonably valued, and you expect the same multiple to be there when you finally exit the stock. That stock could also give you 15%. So finally it's a combination of what are the growth rates in sales, what will be the impact on margins, are they expected to remain constant, go up, come down, what is the capital efficiency of the business. Some growth can in fact be hugely damaging. So in airlines we saw that people who bought more planes went bankrupt faster. This is in the earlier era. So you have had bankruptcies in, let's say, Kingfisher and Jet Airways and various other airlines. So growth has not only, you need volume and sales growth, you also need profitability and capital efficiency. So all these have to be seen in conjunction. If you went to a doctor or you got your annual medical checkup done, then the doctor would not focus on just one parameter saying blood pressure is this and that's it, then I'll prescribe medication. The doctor will go through the blood pressure levels, the sugar levels, the cholesterol levels, the x-rays and various other things, sonography and all that. So same way, when you invest, you have to look at various parameters. You can't just go with one parameter and say I'll invest based on this. That's where growth is when you look at growth, that growth is factored in the intrinsic value calculations, and then you try to buy at a discount to the calculated intrinsic value.
I don't want to get into individual stocks, but can you give some example on where you considered this is a value lucrative stock? I mean, growth is there. As you said, everything should be looked in conjuncture, but then one stock, that you pick because it's a value lucrative, the other one because it's growth, because you follow both.
So I'll talk about the last published fact sheet that is there for our fund. Now, a lot of people look at companies like, let's say, Alphabet or something as growth companies. It does not pay out anything, but the cash that they retain, they put it to good use, and sometimes they do stock buybacks as well. There is another company which a lot of people consider as a mature company, as a sector which does not have too much of a great future, and I would tend to agree, which is Coal India, where if people move away from fossil fuels, you won't expect spectacular volume growth in such kind of businesses and things like that, but valuation is such that it can give you a decentish holding period return. So you have in your portfolio all kinds of companies, and as long as they meet the parameters in aggregate, one should be fine.
You are a seasoned fund manager now, but you also evolved, over the years. You did chartered accountancy, one thing that is common between us is even I'm a chartered accountant. Having said that, how did you end up landing in PPFAS? How did you evolve as a fund manager?
Sure. So they say spirit of the times, or sometimes some things are in fashion. So if we were maybe living in many decades ago, we would be wearing bell bottoms today, because that was the fashion then. So my graduation year was 1992, and at that time everyone in the commerce field wanted to join the stock markets. So there's not much science behind it. Once we went through the tough times of having to pledge our gold to get foreign exchange and keep our country running. After that, the IMF-led reform process and the budgets of Dr. Manmohan Singh and all those came about. In between, there was this Harshad Mehta stock market boom. So the financial sector was very, very attractive for young people. So when I joined chartered accountancy itself, I had made up my mind I'll go into the financial sector. So we are supposed to do 3 years of article training. So I did 2 years of articleship, and the third year on optional basis one can do industrial training. So in the third year itself, I joined the financial sector in the merchant banking division, and we were doing IPOs and things like that at that time.
You didn't like what's going in the auditing side?
At that time it seemed lucrative joining the financial sector in 92. After that, for almost a decade, it was a question mark whether that was the right decision or not, because those index levels never came back. After that, there was a huge crash and things like that. And for some time, I was moving from department to department. So I had joined on the merchant banking side, which was involved with bringing new IPOs to the market. And then the IPO market completely dried up. So there was no work in the merchant banking division. So that was the time when bonds were taking off. So from a high of 14% interest rates on government bonds in mid-90s, we kept seeing lower interest rates. So bond market was doing well. So for a few years, I was in the government bond department. In fact, PPFAS, I joined on the government security side in 2001. Yeah. And then over some conversations, I had some interest in the equities, and my feeling was that after 1 decade of underperformance, equity was ripe for its time in the sun, and bond yields had fallen sufficiently enough, and there was not much scope left. So that's when I transitioned to equities. This was in 2003.
I hope you don't find any other asset class more attractive than equities.
Yeah. I think now I'm in a happy position where I get to oversee various asset classes. So we run a liquid fund, we run an arbitrage fund, we have a conservative hybrid fund in which we invest in things like REITs and InvITs. So in the mutual fund space, if I like another asset class, we will probably have a scheme designed to invest in that asset class.
What have you learned from late Mr. Parikh at that point in time? I've come across one handwritten note by him in which he talked about facing fears. It was beautifully written and shows the vulnerability side, you know. It was really nice. So what have you learned from him? He's known for his behavioral finance concepts and explaining them, and expertise on that. What have you learned from him, both from the investing side and also from the life lessons that you have learned from him?
So behavioral finance is a very, very obvious one, so we'll talk about that. But more importantly, interacting with him as part of an organization, one could clearly see that he saw the organization as an extended family. It was never just about financial performance of the company or sales targets or anything like that. He was a great proponent of living a complete life rather than just focusing on the act of making money or driving sales or driving assets under management or things like that. in his workplace, in his cabin, there used to be a guitar kept where he would strum once in a while. He would every day take 45 minutes or so, 30 minutes to 45 minutes to meditate in the afternoon. Uh, he would encourage people to leave office on time, which is very contrary to popular culture where uh, people are expected to put in long hours. So if he saw people working beyond what was expected of them, he would try to figure out what is going wrong. Are we understaffed? Are the processes not proper that people have to put in so much effort? He would take interest in the families of people working in PPFAS. How are their equations with their parents, spouse, children? What are they up to? Yeah, it was a mentor kind of relationship, or another father figure. So biological parents are of course there, but in the professional world, someone who would oversee the career paths of various people. So he was that kind of a person, which is very, very difficult to replicate or to find outside. But behavioral finance, of course, I had read his articles even before I applied or joined PPFA, so I knew about him and about this field. And the first introduction to the field of behavioral finance was through his writings. And he was a continuous learner, so we would get to read the latest books in the field or to read research papers around what is happening.
Maybe if you have to say one thing that really, really helped you, from the investing side.
I think courage of conviction. See, I like to tell people that any investment manager has three bosses. One is the end client. The client in an open-end structure can fire you anytime. Here is my redemption, give me my money back. The second boss is the person who got the client to you. This could be a mutual fund distributor, or it could be an investment advisor, it could be a magazine which puts you in part of the select group of funds and then says, no, this is not doing well and you should redeem. So that is the second boss. And the third boss is the organization CEO, the head who leads the organization. So any of these three bosses can fire you at any time, and unless all three are in alignment, the fund manager's job becomes very, very difficult. Now, in any period where the scheme performance is not keeping pace with the indices, or where other people are seeming to make more money than you are making, there is temptation from the client side or from the advisor side saying, let's move the money. And it's very easy to give up your convictions at that point in time. But he was someone who stood behind the investment team as long as they were doing the right things. So in 2007, we were not participating in real estate companies. We were not participating in the commodity companies, infrastructure companies that were doing well at that point in time, because we did not find those meeting our investment parameters. And we were underperforming the index by a huge margin. So at that time, some clients redeemed their investments. We were in the portfolio management structure at that point in time. Or some of the relationship managers in our own team were upset, saying, what are we doing? Our schemes are not doing well. Clients are upset. Should we change our approach and things like that? And Parag said, nothing doing. This, even before we started the journey, we said, this is our route map, this is the guiding principle, we stick to it. And it's been famously said, you have a choice whether you want to lose half of your clients or you want to lose half of your clients' money. So for us, the answer was clear. Even if we are losing clients, we will not lose client money by doing foolish.
I remember in one of the AGMs you also referred to this, that you volunteered yourself and said that you want to resign.
Yeah, I said I am not understanding these companies. So all of my colleagues who are facing clients are in a difficult situation. So if you want someone else to manage it, I am happy to step aside. I am happy to resign. So he said, nothing doing. You have to be there.
How were you when you started your career, Rajeev? Were you very ambitious that you want to become the successful fund manager? You also attended Berkshire Hathaway meetings. You've seen Warren and Charlie. Have you ever thought, okay, I have to become, one such investor?
So the good part about knowing Warren and Charlie, or knowing how they operate, is that it's more of a way of life rather than some financial numbers. So their lifestyle is very, very similar to what the lifestyle was when the net worth was far lower. So visiting Omaha, looking at the home that they live in, the office where they work, makes it very, very simple, saying enjoy the journey rather than be focused too much on a particular destination. So then the ambition really goes away. So even like Buffett and Munger, they are not known to put in long hours. They do serious work while they are at their desk and reading, but beyond that they live simple, enjoyable lives. So that was what was inspiring, knowing about them.
Sad to see Munger go. It's his quotes, whatever I've learned, it's not just relevant to the investing side of it, but it's also more to do with the life aspects as well. And he clearly, he says that it's very important to, do work with people that you enjoy the most with. You also alluded to that. At PPFAS, it's famously called RRR, now 4 R's, Rajiv, Ranak, Raj and Rukin, plus N with Neil Parikh. So what's your relationship with them?
So relationship with Neil, which is the longest, so he was the first to join. He joined as any other employee, so it's like a friend, like a office colleague, rather than someone who is a substantial shareholder of the company and CEO of the company. So we've been friends for a very, very long time, and it's very, very comfortable. With Ronak also, it's been a very, very long journey. He joined somewhere in 2008, and again his way of thinking is very, very similar to what the organization's ethos is. So again, a very, very easygoing relationship, and again we've been through good times and bad. In the accident, he was sitting next to me in the car, so we've been through all the ups and downs. So it's again a very long association and a good journey. Interesting thing about Raj is that we used to be neighbors. We still are neighbors in some sense. So I have known him outside of work, growing up as well. So his trajectory has been very similar to mine. So he did chartered accountancy, then pursued the CFA designation and things like that. And initially he joined us as a intern, but then he liked the organization liked him, and then he became a permanent part of the team, and that's how the equation goes. So we are family friends also, apart from being office colleagues. And although Rukun has joined relatively recently, but we have known him for a very, very long time, all of us in the investment team. So he's been coming to Oktoberquest, our annual meeting, for a long time. He's taken the erstwhile MDI course with Professor Sanjay Bakshi and understands the value school and the Buffett and Munger way of investing. So again, all associations go back quite a while in time, and it's a very, very easy-going, free-flowing conversation when we are together.
Yeah, especially when it comes to investing, the value alignment should be very good and smooth. So how do you go about recruiting the other research team members? Now the research team is also growing, so how do you go about recruiting them? What do you ask?
Yeah, so some people think that we start with the name and there's some numerology angle to it. So unless the initial starts with R, then other CVs get eliminated straight away. But that is not the case. So people other than in the investment team, in the fund management team, analysts have different names. So we have names starting with A, which is Abhishek, and we have Prithvi, etc. So essentially we are looking at people who think in the same manner as we think long term, think business quality, management quality, and look at investing at reasonable valuations. We look for complementary skills. So having knowledge of a sector where currently we don't have too much expertise, that helps. So that would be a valuable addition to the team. And technical skills obviously are required. So ability to read an annual report, to do financial ratio analysis, or to look for red flags in accounting notes, do basic due diligence. All those things are obviously a given.
Why don't you tell us about the methodology of picking a stock or exiting a stock? And the basic filters you follow.
It's been said, and globally this sentence is famous in the investing community: price is what you pay, value is what you get. In the Indian context, someone has modified it: price is what you pay, value is what the promoter will let you get. Right? So in the West you have all these activist shareholders who will vote out the CEO or vote out the board of directors. In India, in most cases, either you will be partnering with the government, or you will be partnering with a business family, or you will be partnering with a MNC. And in all these three cases, the dominant shareholder will own maybe 50, 60, 70% of the company where you are buying the shares. So you cannot vote out the board of directors. We cannot say that, okay, now the ministry should not appoint the managing director or should not appoint the board of directors. If you are buying shares in the oil marketing company, the MD will be appointed by the Ministry of Petroleum and Natural Gas. So that is the first filter. You should not buy shares in the company where you are not comfortable with the promoters or the managers, because after you buy, there's nothing you can do about it. They will continue to run the company the way they have been running, and your voice will matter only to a limited extent. Once you have chosen the promoter and management group.
Before you go ahead, have you ever used that right? Have you ever exercised that right as a minority shareholder, or now the domestic institutional shareholder? Have you ever exercised that right, saying that so and so person in the management is not doing well?
So Satya, that is now mandatory for all mutual funds in all resolutions. Okay. So we vote each and every resolution that comes our way, and there are these proxy advisory companies which go through the resolutions with in great detail, and our own analysts also do work on this as to whether some resolution is in favor of minority shareholders or it's not in favor of minority shareholders. We vote on them, and it's also disclosed on our website, so people can go and see how we have voted on various resolutions in the past.
Interesting. Yeah, please go ahead.
Yeah, so once you have covered the promoter and management part, next comes to the business quality. Now, a leading business house in India is very, very successful in their software venture, which is TCS, and they haven't done that well in, let's say, fields like telecom or in fields like airlines. Airlines, of course, they have now again redoubled their efforts, but again, some businesses inherently generate a lot of cash flow, have decent prospects for shareholders, whereas some other businesses are very, very capital intensive, and one has to go through a long gestation period. So we choose the right kind of businesses which excite us as minority shareholders. And once these two things are in alignment, then we wait for the right valuation to invest in.
Now, if I have to ask you to prioritize, the following styles of investing by going by the metrics. So, when we say growth or when we say value, there are certain metrics that are attached to it. So, growth, value, contrarian, momentum, quant, what would you choose?
I think growth, which is part of a value, so value is what we look at. So momentum will come and go over a period of time, so it's largely short-lived. So it's more akin to trading rather than longer-term investing. Growth, as I said, is a part of value, so it's already captured in the value. Contrarian, being contrarian for contrarian's sake, does not make sense. Sometimes you agree with the crowd, sometimes you stand away from the crowd. So I think essentially what we are left with is the value.
What's the source of the information that you consume on a day-to-day basis? Do you ever get FOMO with so much happening, so many articles, stories?
Yeah, so there was a point in time, maybe 2 or 3 decades back, where people were starved for information. So annual report would be a very, very precious commodity, and there were vendors who would sell digital copies of the annual reports or would sell photocopies of annual reports. To the environment today, where largely one has to figure out how to filter the information and reduce the information available to a size which can be easily consumed rather than cause indigestion. So what one filter that is very, very helpful, at least to me and to our way of investing, is that we focus on slightly longer term data and not focus too much on very, very noisy short term data. So if you are sitting on the seashore, each wave coming in, going out may not give you that much of information. But if you look at the sea level over a period of time, you can figure out whether you are going into a high tide or a low tide. You don't need to measure each wave to figure that out. So similarly, things like monthly sales may not matter so much. Quarterly sales would matter more than monthly sales. Annual sales would matter more than quarterly sales. So in India, we have the festive season of Dussehra, Diwali, all this, and a lot of sales happen around the festive season. Now the festive season itself moves. It's not a static date as per the Western calendar. So a lot of the year-on-year comparisons that we make are spurious, because last year Diwali may be on a particular date, this year it may be on some other date. People measure quarter-on-quarter performance. Some quarters have a certain number of days, some other quarters may have a different number of days. So focusing too much on short-term data actually confuses you a lot. So we try and filter out the noise and focus more on the signal, longer term signals.
It's easier said than done, but do you ever have this FOMO, fear of missing out on some of the information?
See, as long as we communicate the process clearly, internally to our team, to other people in the department, to distributors, to advisors, to the media, to end clients. I think if everyone is in alignment, this fear would not come. So we have clearly said that this is our approach. Someone else may have a different approach, and if that works for them, it's good for them, but we are not doing that. So just yesterday we had the annual meeting and we spoke about this. So if we are running a Udupi restaurant and we serve the best dosas in the city, we should not worry about someone else serving great sushi. That's good for someone who's interested in Japanese food, but then we should not try to do everything and be everything for all people. So our approach is this particular approach. In FOMO, if there is a company which is a new listing, which does not have a profitability track record, we don't do those kind of investing. Now someone may make a lot of money in buying startup kind of companies, but we are investors in slightly more mature companies where at least there's a track record of some profitability and unit economics. So once you know who you are, it becomes very, very simple. So someone who's a great tennis player should not have FOMO of not being a football player.
Right. Yeah, there are systems in place, you are communicating, but I want to understand this, Rajiv. Is there intuition? Does intuition play a role in investing?
As long as something is not defined, we call it intuition. Over a period of time, more and more things which earlier were in the domain of intuition get codified, and then it becomes a system driven process. But yeah, I don't think we have 100% codified each and everything that is out there. So to that extent, there is that residual box which we would call intuition.
Yeah, they say absence of evidence is not equal to evidence of absence.
So intuition may have a role to play, but overall the other criteria also has to be met. So it is not that intuition will override what hard facts are telling us.
When it comes to the performance, now Rajiv, here I'm just talking about the flexi cap fund. You know, if one goes through the trailing period, point to point, and also the rolling returns. I'm just looking at 5 years and above here. Since you clearly mentioned in the catalog itself, the fund house clearly mentioned in the catalog itself that it's only for investors who want to remain for more than 5 years. So I'm looking only at that period. It has given decent alpha, let alone beating the benchmark. And if one has invested during the inception of the fund, it has given 20%, close to 20%, which is impressive. But since I'm talking about evaluating a fund manager, they say that it's important to evaluate a fund manager based on market cycles. You have to see how they performed over the cycles. Can you tell us about the performance of the fund over market cycles as long as it existed?
So the data is in public domain. So for good or bad, we publish daily NAVs, we publish monthly fact sheets, monthly portfolio disclosures. What we have seen is that when things are going up at a very rapid pace, we have tended to lag the overall market. And when crashes have come, we have, at least in the past, been able to fall lower than what the overall market fall has been. So 2017, for example, was a year where we were underperforming the index, where there was a huge rally in the small and mid cap space. Also, given that some portion of our corpus is invested abroad, the entire ups and downs of the Indian stock market are not captured over there. So the impact is somewhat muted, both positive as well as negative. So we had a surprise corporate tax rate cut announced some time back. At that time, Indian markets obviously went up very significantly. In our portfolio, only the Indian component went up. Obviously, foreign stocks do not benefit from that. Again, at the time of, let's say, a demonetization, which again was a surprise. So the overall market fell somewhat, and to that extent, our fall was slightly lower. So that's been the experience overall. But broadly, over the last 10 plus years of flexi cap, generally we have been in a rising market. So to that extent, we haven't seen a prolonged bear market per se.
When analyzing the funds for our portfolio, they say it's better to have different styles of funds, because if you have a growth fund focusing on growth, it's better to have value, because when growth is not performing, value may actually compensate for that. Now, is it what we have to remember from PPFAS Flexi Cap Fund, that it may not be the winner amongst all the funds, but when it is rising, it may lag a bit, but when it's falling, it will reduce the...
I would expect a similar, this is the outcome we have seen in the past. Future obviously is uncertain, and sometimes things could do differently, but given our approach and portfolio construct, I would expect something like that too.
PPFAS has a real cult following. I'm sure you would have known that. Coming from the media space, I know that every article that is written on PPFAS will have good reader interest. But there also, with fame also comes critical observation of how the fund is performing. There are also talks about how the fund is underperforming during certain periods of time. As you said, in 2007 you thought of you volunteered yourself to resign, and in 2022, I mean, you said that we've underperformed. Earlier also we underperformed now, and in future also we may underperform. How have you evolved? How are you coping up with underperformance? It's definitely easier said than done.
Communicating that come to this fund only if your horizon is more than 5 years, that helps at least putting the expectations right, and people give us that much time where they don't worry too much about 3 months, 6 months, 1 year kind of underperformances. They look at the overall longer term track record. We haven't seen a meaningful period of underperformance in the long run. So how we will cope with that, we'll know only if and when that situation arises. The shorter term, I think, has been more or less easy to cope with, and people have kept the faith and been with us across ups and downs.
No, just wondering, even during the underperformance, even for the short period, though we have systems in place, though we have enough conviction, sometimes there could be some doubt about our systems. Is this system according to the new age, what's happening? Is it right? Have you ever felt that doubt that the systems are in place are meaningful to the current generation?
Yes, so there's this wonderful book called Thinking in Bets, which talks about focusing more on what you did rather than focusing on a particular outcome. Now, let us say I pulled out a coin from my wallet and we said that we'll flip a coin, and through our measurements, through statistical analysis, through the weights of different sides, we know that 70% of the time the coin will turn out to be heads, and only 30% of the time it will be tails. Now, the right strategy then would be to bet heads on each and every flip of a coin. Over a period of time, you will win more than you will lose. But does that mean that each flip of the coin will be head? Answer is no. 30% of the time you will get tails. Does a good sports player win each and every game that sports person plays? No. So does Virat Kohli score a century each time he goes out to play? No. So as long as longer term track record is intact, and as long as you are following the process that you have set out to do, I think things should be fine. And these principles, one, have been time tested by various investors in various markets, in India, abroad, over many decades. So I would believe them to be true. Second, even from first principles thinking, I think it makes sense, intuitive sense. Buying undervalued companies will give you better returns than buying overvalued companies. Now, can one logically argue against this? I would think not. Investing with honest and competent promoters and managers will do better than investing with crooks and incompetent people. Again, it's first principles thinking. So, if for some period of time it doesn't work in a particular 6 month, 1 year period, good promoter house is going through some challenges and some badly run companies having a bounce in the stock price, should we change our fundamental approach? I don't think that is the answer.
Just curious to know, does your meditation help in, spirituality help in making good decisions?
It definitely helped in 2020. So that was a time when so much stimuli was there, and there would be health press conferences all the time. There would be regulations announced for companies. There would be fiscal stimulus, or which would either exceed expectations or be lower than expectations. RBI would do something, Federal Reserve would do something, it was a chaotic time. So in that period, and again, investors were jittery. Is this a great opportunity where we should put in a lot more money, or is this end of the world and we should pull out whatever is remaining? That was a key question. So at such a time, focusing on things that are in our control and not worrying too much about things which are not in our control, and doing the right thing, I think that really helped. So 2020 was I'm not a very, very regular meditator, let me put that clearly, but whenever the need arises, it's a tool which I've been able to use very, very effectively.
Now, coming to the most asked question in the AGM, it's about the AUM. Now, the organization started as a PMS, converted itself into a mutual fund in 2013. Started with a small AUM of few hundred crores, and as Neil from Mint mentioned in yesterday's AGM, that it has now been the second largest actively managed fund with 50,000 crore. Am I getting my...
Yeah, so it depends on the way you look at it. If you look at pure equity funds, then HDFC Mid Cap is the largest and we would be the second largest. But if you include the balanced funds that are there, aggressive hybrids and the balanced advantage funds and all, those are at 60,000 crore plus, quite a few of them are there. So depends on how you rank it. If you take only pure equity funds, then yes.
Now, coming to the question, yesterday in the AGM also, you're showing in the presentation that you're not scared of AUM or underperformance, you're actually scared of people's expectations. But you would have answered this very elaborately in the AGM, but for the benefit of our listeners, how is it managing the fund at different AUMs like?
We are roughly 1.75% of the equity AUM of the AUM that mutual funds manage. So if you see there are 50 fund houses, you would on an average expect them to have roughly 2% of the assets. So it's somewhere around the average assets that mutual funds manage. It's not exceptionally high. The reason why it looks high in our case is that we have the assets in a single scheme or in a limited number of schemes. Elsewhere, the practice is to launch multiple schemes for different sectors, to launch multiple schemes to invest in large and mid kind of thing, mid and small, those kind of segregations. That is not there in our case, and that's why everything looks concentrated in one scheme. But what is more important is that how much a asset management company can invest in a particular company, listed company, that is determined by regulation at 10% of the overall paid up capital of the listed company. It does not matter how many schemes you have, everything is totaled up and then that 10% is considered. Same way, the buying and selling gets aggregated at the dealing room level, and the market impact cost both while buying and selling are the same. Doesn't matter. So in the note to unit holders, we said that when you consume one full pizza, the calories will be the same whether you cut it into 4 slices or 20 slices. That does not change. If you cut it in more slices, it doesn't become more healthy.
But how is it managing? I mean, have you understood that? But within the scheme, is there any difference?
So let's say last fact sheet, I don't remember the AUM, it would be approximately 45,000 crores. April 2020, we were around 3,000 crores. If you look at the fact sheet, the kind of names that are there, the kind of weightages that are there are more or less the same. See, again, the buying selling that we need to do in the market is either based on fresh inflows or on redemptions. That is one reason to buy or sell. And the second reason is where we are exiting a particular company or switching from one to the other. So we have never been a high churn fund. We have been buy and hold investors. So as long as we are not in a hurry to buy or not in a hurry to sell, we've been able to manage quite comfortably, at least so far.
People respect the organization for a reason, I guess, because the number of schemes that are coming out are also very limited. I remember Neil Parikh said it's an AMC, asset management company, and not asset marketing company. I think that's also adds to the respect that you guys have. But generally, how is your day like, Rajiv, on a day-to-day basis in the organization? How does it look like?
So there are two kinds of days. One is when I am in office. The other days where, for some reason or the other, I am either attending events locally or traveling somewhere or things like that. So at least 9 a.m. to 3:30 p.m. Now there are strict regulations of communication and things like that. So largely that time is spent on the desk reading stuff. Once in a while we may have a video call or a phone call which is recorded for regulatory purposes, but that's largely it. And other days where we are either going on a research visit or where we are attending an event or traveling out of station, what we do is the fund management team ensures that certain fund managers are in office and some others are outside. So the people in office are in charge of the dealing operations, buying, selling, and all that, and the people outside don't participate in that activity at all for that particular day. Then we would be at some broker conference where we would be meeting multiple companies, or we could be attending industry events and things like that. So then it's a very, very varied day.
I was also talking to Shailendra about how you are at workplace. So he was also referring to how you are calm. First thing, of course, everybody mentions that. The second is how you give a rationale for everything you say no to. I think that's also a very important part of communication. He's also saying that it makes my work easy whenever he gives rationale for everything. And also how you take very small things at office, also a little importantly, that every time there is an event organized in the office, that you are the first person to come and stand.
So the last one, over a period of time it has changed a bit. So at the initial stage where we were a very small company, people had to multitask. So each small thing, big thing would come to the same set of small number of people who had to do the work, take decisions and things like that. Over a period of time, as more people have been added to the company, the roles have become more specialized. So a simple thing like going on a company offsite or a picnic, earlier a different set of people would have to coordinate. This time, at least at talking for myself, I did not have to do anything. There were a lot of other people who did this stuff. Even for the AGM, apart from the presence and answering the questions and making the presentation, rest of the arrangements were made by people who are in charge of that activity. 5-7 years back that was not the case, so we would have to figure out who will handle the streaming and whether the internet connection is proper or not, or those kind of very, very basic things. But otherwise, yes, so I think there used to be some company where if you just gave a decision and did not give the reason, that was an offense which could result in a job loss. So it's very, very important that people have an understanding of why things are happening the way they are happening. So we have a pretty open culture of information sharing and communication. We have a monthly business meeting where people across the hierarchies are there, and they get insight into where the company is going and what are the plans. And
I really liked when in the AGM also yesterday you called up all your research team also, acknowledged them. It was really nice. And sometimes when you are talking, you also refer to a lot of documentaries, TV series. You watch a lot?
I do. So watching the big TV screen is a big part of my existence, whether that is a documentary or something fictional, but I spend a lot of time watching video content.
What are you watching now?
Yeah, last 2 weekends haven't got much time to watch, but the last thing that I found interesting from the business perspective was this Netflix documentary on the vaping products. So it's, I think, a 3-part or a 4-part series where this product called Juul was launched in the US, and instead of people lighting up a cigarette, people would put something which resembled a USB stick kind of thing and could get a nicotine hit because of that.
Something similar to e-cigarettes.
So e-cigarettes were, it's a kind of e-cigarette, but the other e-cigarettes were so bad looking and they did not get too much acceptance. This became almost like a cult product, and it had very, very wide acceptance, and there were certain problems which came about because some off-label capsules were used which were not permitted, and that caused certain people to be hospitalized and all. So it was a very, very interesting documentary on the whole tobacco industry and the alternatives to that and things like that.
You also read a lot?
I do. Reading is again a big portion of what I do.
Again, what are you reading currently?
Two books that I read last year. One is something to learn from, and the other is pure entertainment in terms of what is happening in the startup world. So the first one is the Ambuja story, which is the journey of formation of Gujarat Ambuja Cements and all of that. And the second is Doglapan by Ashneer Grover. So that was more for entertainment.
Yeah.
Also read this book on Bridgewater Associates, the fund is the title of the book, which came out recently.
Briefly, can you also talk about the portfolio construction of the flexi cap fund, the large, mid, small, and also the international stock exposure? Briefly.
That varies over time. Currently the small and mid together would be around 14%. The international would be in the region of 15-16%. Overall cash levels would be in the region of 15%, and remaining would be in the larger companies.
There were times when there was a high level of cash levels also in the fund. I've been reading something, I don't remember who exactly said this, but having so much of cash and not investing is also a very important decision, and it's a brave decision as well. Anything about that? The
Nifty, if you look at it over a period, let's say 2005 till date, on a 5-year or 10-year basis, rolling returns, average it has given somewhere around 12%, slightly less than 10. Slightly less than 12. But the ups and downs in the market have been far more volatile. Now you know that the market will be very, very volatile. It will randomly go up, it will randomly come down. But you don't know what will happen tomorrow or any particular week or any particular month. You do not know what will happen to an individual company or a sector. When you have stocks in the portfolio, and when you have cash, you can take advantage of both kinds of opportunities. So in one of our smaller funds, the conservative hybrid fund, we used to own a company called IRFC, which was more for dividend and regular cash flow. But suddenly the stock price went up 3x. Now that gave us an opportunity to sell the stock. Similarly, if you have money in the bank account, now 2020 happens, if stocks fall by 30, 40, 50%, that money in the bank enables you to buy stocks at that point in time. Now, if Nifty is giving you 12% and if money market is giving you 6.5, 7, that 5.5% shortfall in returns can be made up in one decision if something comes your way. So, someone has beautifully said this, cash holding is a free call option on an undefined security at an undefined time and at an undefined strike price as well. You do not know what the price will be, but you can avail of that only if you have money. If in March 2020 you know that market is very, very attractive, but your bank balance is zero, you can't do anything about it.
When it comes to the international investing, this is the first, fund house, one of the first fund houses to actually look for the opportunities abroad. And as you earlier also said, there are two reasons why you invest abroad. One, because the holding company valuations are cheaper, and second, opportunities that are not available in India are available outside India. Now, of course, there are also restrictions on foreign investing. What is it going ahead?
I think the same rationale continues. You see, today the country of listing does not matter so much. So Make My Trip is a largely Indian company, has operations in India, but it's listed in US. Investor here cannot buy shares of Make My Trip. Today, Wipro, Infosys, TCS are listed here. Their customers are in the West. Most of the work gets done in India or other low-cost countries. Companies like Cognizant and Accenture also have the same business model, but they happen to be listed elsewhere. Companies which are operating in India have large foreign subsidiaries. So if you are buying Tata Motors, apart from what the car sales are there in India, you also have to look at what is happening with Jaguar Land Rover. So increasingly it's a global world. You have to go where opportunities are, not worry too much on the country of listing, and some of the opportunities available in the overseas markets are not available here. So if you want to invest in a good social network, those companies are listed abroad. If you want e-commerce companies, although something like a Flipkart operates in India, but it's owned by Walmart, so you cannot buy those e-commerce companies.
Your international investing started with Google?
It was one of the early companies, yes.
That you went to Berkshire Hathaway.
Yeah, it was
Why
Mr.
don't you tell us
Munger.
that
Was Mr.
story?
Munger who, when asked which was the most interesting book that he read in the last year, he spoke about the book In the Plex, which was on Google and how they are doing wonderful things. And he actually looked at the audience and he said this, we will probably not take advantage of this, but maybe people sitting in the audience could. He was, to my mind, giving a stock tip to people who were there.
Yeah. And you came back, bought that book, learned it.
Yeah.
Interesting. Yeah. Also, one thing that is again unique to PPFAS is its communication to the unit holders more often. For those who doesn't know about it, they conduct AGM every year, and where the unit holders can ask questions each for about every individual stock as well. It's interesting that every year there is one theme when it comes to the investors' questions or the unit holders' questions. Once it is about ITC, once it is about underperformance, once it about, yesterday about AUM. But two things that remain constant every year is the key managerial risk and the listing of the firm. let's talk about the first one. It was also nice when you said internally they are thinking that you fabricated the question. How does the organization think about it? I know, I mean, Neil answered it very, very beautifully, that the relationships goes beyond being colleagues. But yeah, for the benefit of these listeners.
Sure. So it's been a 22-year association now for me with PPFAS. I joined in September of 2001. It's a place where I like working. So it's not just about how much AUM you are managing, what is the salary that you draw, or any of those. You should, end of the day, have friends in the workplace. You should enjoy working in a particular organization. Your values should be aligned with the value systems of the company. So all those alignments are there. So then why would one look to go elsewhere? At the same time, I've been saying this over many years now. It's guaranteed that someday I'll not be managing this fund. Now that could happen for various reasons. It could just be that I'll be old enough that someone else has to manage it. It could be for a variety of reasons, but the key point is that, are we moving in a direction where the organization is robust, where they can manage the change or they can manage the transition? So this was the 10th year of our AGM. If you look at the AGM videos, earlier it used to be Parag and me. Then over time, you have had Ronak coming in, Raj coming in, now Rukun is there, Neil is there. So the strength of the fund management team has increased, the research team size is increased. I think we are moving towards a organization will be able to handle the transition. So yesterday I spoke about, let's say Mr. Uday Kotak is no longer the CEO of Kotak Mahindra Bank, but the bank is still operating, and which is a great thing that Mr. Kotak has achieved, that he has built an organization that can continue even if his presence is not there. Mr. Aditya Puri no longer is there in HDFC Bank, but the organization goes on. So yeah, one has to build robustness in the company.
I want to end this conversation by asking about the behavioral biases. In the markets, it's good to have systems. It's the style matters, everything matters, but also at the end of the day, how we behave actually tells us what kind of returns that we get. The controlling emotions plays a major role in investing. I know you already alluded to that, about how systems are in place in the organization, but can you tell us, are there any personal behavioral biases that you overcome over the long years of your journey at PPFAS?
I think most investors go through this journey where initially they focus too much on the price that they are paying and the valuation multiples and buying things cheap, and it's later on that they learn to pay up a little bit more for the quality of business. So I have had a similar transition. So the first decade of investing was largely personal investing. I was not handling professional money, but 2003 onwards, when I started managing professionally, I came in touch with Mr. Chandrakant Sampath, who was a mentor to Parag Bhai, and he and my colleague Nirjar, and reading about Philip Fisher and Munger and all, brought forth the importance of focusing on quality as well.
Brilliant. I think investing is a very makes us very humble, right? I mean, because when we see when the data says we are wrong, we have to admit it's wrong. Right. That's all, Rajeev. Maybe something about, is there anything that I missed about the core philosophy of the fund,
No, I think we have broadly covered all the aspects.
Sure. Personal financial goals.
Sure. So, the personal investments that I have may not be very, very suitable for a wider set of investors. So, given that I work in a company where we manage investments, I have concentration in a single fund, in a single style. Apart from that, a big portion of the investments are in the company itself, which are illiquid in nature. So the reason why I can be so concentrated is that the cash flow needs are not that high. Right now, as well as in retirement, I'll be able to meet the cash flow needs relatively easily. So then the concentrated portion or the liquid portion, that may not matter so much in the overall maintaining the basic expenses.
What does wealth mean to you?
Wealth means that you don't have to think or worry about money. It's not about having too many possessions, or it's about having a lot of time to do things that you really enjoy and you wish to pursue, and it's about the freedom to live the life the way you want to do, the way you want to live, and to associate with the people you want to associate with.
What do you say about the work-life balance?
I think there is no fun in working endlessly and then getting into poor health and then just passing away. That is not what we are meant to do. Work, health, relationships, community service, all these are important facets of life, and you can't just focus on one facet and ignore the other things. In fact, people who do that are able to do it for a small stretch of time, but then those compromises come back to hit you, and then a simple thing, if you are working long and ignoring health, eventually health will give way and you will not be able to work even the bare minimum that you need to. So it's never a good idea to not have balance.
What do you do for health?
One thing that I've been able to do relatively easily is control food. The one thing that I've not been able to achieve enough success is exercise. So I should be exercising far more, but food control is reasonably good.
What's your stress buster?
I think my daughter is the biggest stress buster. Being around her and just talking to her takes away the stress.
Wonderful talking to you, Rajeev. Thank you so much for joining.
Thanks, Satya. Thank you so much.